Hey guys, welcome back. Super excited because today I've got a really interesting guy, Yonah Weiss, and he's with Madison Specs. He has several business ventures that he's involved in. And I think you guys are going to learn a lot today because we're going to talk about taxes. And now I'm losing everybody. Like everybody's just hopping off. Nobody's listening. They're all going to the next episode. No, but on a serious note, we're going to make it interesting for you. And I think you're going to find that taxes are really important and it can be very interesting and very profitable. So, Yona, thank you so much for getting on today. Yona's actually in Israel doing this interview. He lives in Israel. So, super cool. I want to talk about that a little bit later as well. Thanks for being on the show.
Oh, my pleasure, Mario. It's great to be here and happy to talk about cost seg, about taxes. And like you said, for most people, when you bring out taxes, people's brains just like shut off. Like,
arms crossed.
Yeah. Like I have an accountant for that, but the truth of the matter is, if you're an entrepreneur or especially in the real estate business, you want to educate yourself as much as possible in taxes because it's going to save you, hundreds of thousands, if not millions of dollars over the course of your career.
Yeah, and I'd like to just hop right into it. I mean, your business, the one of the businesses that you're in, so you're in the cost seg business. You guys are the largest cost seg company in the country. You also have a podcast called the Weiss Advice Podcast. And on top of that, you're in the title business. You guys do closings and title work. And then also you've been a real estate investor for like 8 or 9 years. So not only are you doing all this cost seg work and title closings, but you actually own real estate yourself, which is pretty neat. Is cost segregation, can you kind of give us just a basic layman's term breakdown of what cost segregation is and why somebody who's buying real estate should actually care about it?
Absolutely. So cost segregation, or cost seg as the cool kids call it, is a tax strategy. And essentially it's an advanced form of depreciation. So a lot of people have heard of depreciation. It sounds like a negative thing, but it's really just the name of a tax deduction. If you own an investment or business property, you're literally able to write off as a tax deduction the entire value of that property, minus the land, a small amount that doesn't depreciate. But it's over a long period of time. So 27 and a half years for residential properties or 39 years for certain types of commercial properties. That being said, that's a long time, right? You take a little bit of deduction, like 2 to 3% of that property value every single year. Don't get me wrong, depreciation in of itself is a powerful tax deduction, right? But what cost segregation does is it breaks down the property into its components, into different individual, items, and shows how some of those items or some of those components actually depreciate faster, meaning you can take a tax write-off of the value of those things at a faster rate. So in summation, it's a cash flow mechanism allowing you to take bigger tax deductions during the earlier years of ownership.
Yeah, so basically if you had 39 years that you had to depreciate something and you could cram that and get those paper losses essentially in a much faster period of time, you're going to save a lot more on income tax for those early years of ownership. And so for who's going to best benefit, from a cost segregation or a cost seg?
Really anyone can benefit from it, but the person who's going to most benefit from it, just kind of in general terms, is someone that has a tax liability, right? So it's not going to be beneficial if you actually can't use those deductions. And it's really important to note that there are certain rules within what's called the passive loss or the passive activity rules, in which someone who is a real estate professional, meaning someone who either they or their spouse are full-time in the real estate business, they're able to benefit the most because instead of just using the depreciation deductions to offset passive income, rental, or real estate income, which is generally how it's used, someone who's a real estate professional actually can use it against active income, against W-2 or any other source of income, which is a big misnomer. A lot of people think, oh, I can just get a costing done and then not pay any taxes whatsoever, regardless of what profession I'm in. Unfortunately, it doesn't work like that. And so you may hear different things on the internet, but you've heard here, the correct approach is to know what your situation is, if you can use those deductions, and then, look into getting a costing done.
Yeah, so I think the underlying disclaimer here is ask your CPA about anything we talk about today because we're not giving accounting advice or legal advice, but he's exactly right. So you may have some very high income and be paying income tax. Let's just say you are, or you're investing passively and you've got a lot of income, that
Mhm.
those losses are going to offset that so you don't pay taxes. And he mentioned something that was really good. You mentioned something that was really good, and that is if you can be classified as a real estate professional in the eyes of the IRS, which there are some qualifications to do that, now you can
Mhm.
kind of bridge that gap from passive to offset passive income into your active income as well. So
Right.
think about this. If you got a stay at home wife or stay at home husband, you might want them to become a real estate agent. And
Mhm.
so on the way to soccer, she's making phone calls about real estate, and that just the tax savings alone could be really beneficial for you. So, um,
100%.
of course, get advice on what qualifies for a real estate professional. But I totally agree with you. And, this is why it's also important and why I wanted you on the show is because a lot of times sponsors aren't, if you're sponsoring syndications or a fund, and you may not be taking a lot of depreciation because you're shifting a lot of that depreciation to your investors. But
Mhm.
that is why you should really understand this, because it's a great selling point to why people should invest with you and buy assets with you, because they get additional tax benefits for investing. Like I just had some newer investors in a couple of deals of mine this last year, and I get a phone call saying, "Hey, we might have a problem on these K1s." And I said,
Mhm.
"Well, what is that?" They said, we got really high losses." And I said, "Okay, so what's the problem?" He said, "Well, is it correct? Is it accurate?" And I
Right.
said, "Yeah." And he goes, "Oh, thank God, this is awesome." He's like, "I needed that. I'm making so much money over at this other thing, and my
Right.
two partners are super excited too because they made a ton of money in some stuff last year." Now, keep in mind, they made cash flow and they made profit, real profit in the investments they did with me. But because we did a cost seg, and because we shifted a lot of the depreciation, all the depreciation, I should say, to the limited partners, to our investors, they got this massive paper loss as well as cash flow. And they were just ecstatic. And I'm like, man, I don't think sponsors really understand how to sell the depreciation and the paper losses to investors. Some people just invest with you purely because of the
Right.
awesome depreciation they can get. So I'm off my soapbox. I'm done ranting. I'm selling, but I'm selling because I use this and it's super beneficial. And I don't think enough sponsors and real estate people understand it. So let's dive into this. Like, how does a cost seg work? Like, what is it? What's the process of a cost seg?
Sure. So it's actually an engineering process. So we mentioned how cost seg is the process of breaking down a property into its components. And it actually used to be called component depreciation, which makes a lot more sense, right? We're depreciating each of those components separately. And so what we're doing is looking at a few different categories. So the first category I mentioned is land, which does not depreciate. The second category is the structure of any property. Now, every property is different. I know you invest in mobile home parks. Uh, which have a very interesting aspect to it. And we'll get into that in a second. But structural components of a property, any other type of property, is really just the building, the walls, the roof, the foundation, doors, windows, and infrastructure, which in mobile home parks have as well, including electrical or septic, water lines. All those are considered infrastructure that has value, and in the most cases, it's the majority of the value of a property is going to go into those structural 27.5 year components. The other two main categories of cost seg, and which the engineer who has the background in construction engineering, et cetera, and knows the tax code, is what's called 5 year and 15 year. The 5 year property, meaning things that depreciate over a 5 year period, which we're going to accelerate that depreciation, are things like personal property or tangible property. It doesn't necessarily have to be movable, like appliances, furniture, equipment, all that counts, but also things like fixtures or window treatments, cabinets, countertops, even flooring like vinyl or carpeting and things like that. All that in any type of property goes into that 5-year category. The second one I mentioned is what's called 15-year, which, believe it or not, mobile home parks have the most of any other type of property, which is land improvements. Now, we mentioned land itself does not depreciate. So you always have to subtract a certain amount from your purchase price to allocate to land, and you're not going to depreciate that. But land improvements, meaning anything that's on top of the land, does depreciate over a 15-year schedule. And that can include landscaping, pavement. In mobile home park, we're talking about the roads, we're talking about concrete pads under each home, like I said, landscaping, fencing, signage, water, storm drain systems, if there's playgrounds, anything outside of swimming pool, all that concrete or pavement has value to it. And believe it or not, in mobile home parks, it's the majority of the value, especially when they're all tenant-owned homes.
Yep.
You're just looking at literally, and we haven't really talked about how much of this we're depreciating, but mobile home parks can sometimes have 50 to 80% of the property value going into this land improvements. Yes. Whereas on a regular type of property, like an office building or multifamily or retail property, you're looking at more like 5 to 10 or 15% of the properties going into that 15-year category. And in those type of properties, the 5-year, the personal property is really what's going to have the larger amount, 20, 25% or so is going into those categories. So all in all, the process, like I said, is an engineering process of identifying what all of those individual components are, breaking it down from depreciation perspective, the value of those things, and then creating a new depreciation schedule showing you how much you can deduct in the first year and year after year.
And this comes in the form of a report after an on-site inspection. It's a very detailed report. I mean, if you think about all the different aspects that he just talked about, I mean, you're talking about countertops and window treatments. It's you don't have to understand the report necessarily to get the benefits of it, put it that way. You don't have to be an engineer to get the benefits from it.
Definitely. And it is extremely detailed. Yes, we have the use of engineers who are qualified in this, obviously understand the tax code, but more importantly is that end product. And a lot of people think, oh, well, my CPA or my accountant, right, can't they take care of this? And the truth of the matter is, potentially an accountant can, and there are some of the largest accounting firms that do employ in-house engineers to do the cost seg. But most CPAs, even though this is a tax strategy, they are not able to do the costing because the IRS requires someone who has that understanding and background in engineering to create the report, and then it's just handed off to your accountant, and they just literally copy and paste and plug the numbers into your depreciation schedule.
Yeah, and I think it's a good point. A lot of times CPAs will basically say, oh, we can figure out the depreciation pretty effectively. I don't think you necessarily need that. But what you're talking about is at a much more detailed level, and you're going to max out your depreciation using a cost seg versus, just what your CPA plugs in for the depreciation, even if they're fairly aggressive on it. So that's a good point. One thing I was going to ask you is what does a cost seg report actually cost, and how long does it usually take? Because obviously tax season is crazy. What's the cutoff as well on when you got to have that completed?
Yeah, so the cost of getting a full conservation study done really depends on the size and type of property. The good thing is it's never going to be contingent on tax savings. So if someone's charging you, and unfortunately, I've heard about this. Madison's like, we're the biggest national cost company out there. So we're doing volume, 5,000 to 7,000 of these a year across the country. But there are companies out there that are charging, $30,000, $40,000, $50,000 to get this done. Jeez. Which is ridiculous. I mean, right? It just sounds ridiculous, and it turns a lot of people away. Like, okay, this is definitely not for me. Currently, and I can speak to now, I'm going to be careful because one time, like several years ago, I was on a podcast. I was like, hey, we're charging X amount. And then a couple of years later, people heard the podcast. I'm like, oh, you still charging that? No, it went up, inflation, et cetera. But currently, it depends. From $3,000 to $10,000, I would say, is like the range, depending on the size and type of property. I'd say the average is around $5,000 to $6,000 for most types of properties. Whether you're dealing with multifamily, office, retail, mobile home parks, that's going to be the kind of sweet spot. It takes us about 4 weeks or so to turn around the full project. And in terms of getting it done before tax filing, You don't need to get it done in the calendar year that you bought the property. In fact, it's something you can do even a year or 2 or 5 years later after you bought the property. You don't need to do it in the first year, but it does need to be done completed before whenever your tax filing is. So I know a lot of people this year are on extension, which gives you obviously a little bit more time. And then the most important thing, I think, for a lot of people is a lot of this sounds like, okay, it's very kind of abstract and out there. Like, okay, you're talking about numbers, you're talking about different components. I don't really get it, right? So we always offer a free upfront feasibility analysis or estimate of any property. So you can, it's educational. So you can see the numbers, you can see what the potential tax savings would be, doing a cost seg versus not doing a cost seg, and then using the bonus depreciation, which we didn't talk about, but that's a way to take a lump sum in the first year of ownership. So with all of that, it's something that is just for you, to kind of bring to your CPA and show what the potential tax savings would be.
Yeah, I would say that, if you can save an incredible amount of money on your taxes, 5 grand is a very, very good investment. And especially if you're sponsoring deals, you're raising capital for deals, it's something that people are going to ask about. I probably have one in three investors investing in my deals asking me about depreciation and taxes, because it's something that they're concerned about, and they're sophisticated enough to understand that these real estate investments do kick off a lot of depreciation and tax benefits. And so they want to know. And even if you're not doing a cost seg, you should at least understand what it is so that you can explain why you're not doing it. Let me ask you this, it's a little backwards. Who shouldn't do a cost seg on their property? I mean, like what would obviously raw land, because there's no depreciation on it,
Right.
but who else should not, where would it maybe not make sense to spend $5,000 to $10,000 on a cost seg?
So there are several, people or types of properties which would really not benefit from a cost seg. And I talk about people first because, as we mentioned earlier, someone who's a real estate professional, if you're able to use those losses against active income, that's where you're going to get the maximum benefit from it. But even
Right.
if you're not a real estate professional and you have enough passive income from this property or several property, that's a great thing. If you have several investments, you can use depreciation to offset income from all your properties, all your investments from one property. So who should not get this done? First and foremost, if the property, if you cannot benefit from it, meaning if you are already showing a loss or you don't have any taxable income, then it's really just kind of churning water. You're not really getting anything from it. Secondly, in terms of the property size does matter, meaning the purchase price. Because of the cost involved, once you're getting over, I'd say anything below $200,000 purchase price is usually not worth it in terms of the cost benefit versus the actual cost of getting the study done versus the after tax benefits of that. Now there are certainly exceptions to that in certain situations, but typically that's like kind of my rule of thumb. If you've purchased property over $200,000, definitely makes sense to look into. There are a couple other reasons. If you're investing from a retirement account, which is a great strategy to use if you have an IRA or a 401k, you can use that to invest in real estate. However, in most cases, that income is already in a tax shelter and cannot benefit from the depreciation, which as a sponsor, someone like yourself who's a syndicator sponsor, if you're taking money from people who are investing through retirement accounts, you just have to know that they're not really going to benefit from the cost seg. And so make them aware. Maybe it's a good idea to set up the operating agreement in a different way. So maybe there's different classes of investors and you can do that. So some class could use the depreciation, another class may not get that depreciation allocation if they can't use it, et cetera. So there are definitely a lot of options when it comes to that. And then another really important thing is, if you're holding a property for a short period of time, okay, because the main benefit, I'd say, if in cost segregation in general, is what's called the time value of money. So we talked about taking, you have this depreciation spread out over 39 or 27-year period, and we're able to pull from that pool of potential deductions and take a lump sum up front. So you're able to use those deductions, you're able to use that cash flow to reinvest. But When you sell a property, you're going to be hit with a tax called depreciation recapture tax, meaning the amount of depreciation that you've taken, you are going to be taxed on that amount. Now, there may be ways to defer that or offset that tax as well. Just because you're subject to a tax does not mean that you have to pay it, right, legally. However, because if you're holding a property for a short period of time, and when I say short, I mean less than 2 years typically,
Hmm.
is the benefit, the time value of money is less. So, like, again, every situation, every scenario is different, and you should consult with your tax advisor and figure out what's best for you. However, those are kind of my general rules of thumbs where it doesn't make sense.
Yeah, that makes a lot of sense. So let's talk mobile home parks. Obviously, the listeners on this show are coming from entrepreneurial backgrounds or they are in commercial real estate of all property types. But there is something unique about mobile home parks. They are very tax. They are. There's a lot of tax benefits to mobile home parks that a lot of people don't understand. You might go, well, how is that possible? Because you don't even own the homes. It's land leases and stuff.
Right.
Can you maybe talk a little bit about that, just for the people who are listening that are in that space or want to get into it?
Absolutely. And the amazing thing about mobile home parks, especially when you are buying a park that's all tenant owned homes, like you said, you're just essentially leasing the space to people who own their own homes in the park. Well, as I mentioned before, in that case, there's very little structural components. There's very little the 27.5 year property, which means there's going to be more of you're buying a property. Yes, there's going to be a land allocation to it, but everything else you own essentially is land improvements. And so let's say you buy a park for $1 million and you allocate, $100,000 to land. That $900,000 in a multifamily property, you're going to be looking at about 20-25% of that you can accelerate the depreciation of. So again, $1 million property, taking 10% to land, you're left with 900,000. You're going to be getting, about I don't know what is 20% of that, 180,000, right? 250,000, et cetera, of your $1 million property. You can use it as accelerated depreciation, meaning taking that over a 5 year period, or alternatively with bonus depreciation, taking a lump sum of that in the first year. Well, with mobile home parks, like I said, it's sometimes 50 to 80% of the property is going into those faster land improvements, the concrete, the landscaping, etc., the roads, gravel, even things like that. It's an amazing. And so mobile home parks are kind of unique in that regard. That RV parks as well and golf courses have the same concept because again, the majority of what you have is the land improvements, and that's where you're going to get this huge amount that you're going to take as bonus depreciation in the first year.
We've had, certain deals where investors have put in, let's say 100,000 and gotten more than $100,000 back in depreciation in year one. And that's not saying every deal's that way. And, but it's very high, especially because we're shifting. This is a strategy that we use as the sponsor. We shift all the depreciation over to the limited partners. So basically to the capital investors. So they not only get their depreciation, but they also get our depreciation. So it's just like, it's very, very good for them if they're looking for depreciation. So, yes, and mobile home parks, RV parks. I didn't really think of golf courses, but that's a great point. Golf courses would, I mean, they probably even have less, less land improvements than mobile home parks. So, pretty interesting. Is I guess from a cost seg standpoint, you mentioned depreciation recapture. Okay. So that's maybe something that people need to think about if they're going to be selling soon, or
Mhm.
if they're not going to want to have to, if they're not going to want to have that recapture to deal with, in the next few years when they sell it. It could
Right.
be a problem to where they're forced to either do a 1031 exchange or they're not able to sell. I talked to a lot of sellers, because we're obviously turning over rocks trying to
Sure.
find sellers. A lot of times they say, I can't sell. I'm fully depreciated and I don't want to get hit with all these taxes and everything like that. And there's ways around it. But I think you make a good point. You need to really understand how long you're going to own something for and what your strategy is before you go, you know, speed up how much depreciation you're getting. Now, when someone's looking at either a cost seg or other tax strategies that you guys do, I mean, what should they be considering just in general? other than the time factor, the property type? Anything else, or is there a big question that you get a lot?
I get tons of questions. I think one of the most common questions that I get is regarding CPAs. And people, for whatever reason, there are a lot of CPAs out there who are just not familiar with cost segregation. Even though it's in the tax code, you might think, well, why not? Like, I don't get it. Like, isn't it something they should be focused on? Well, if they are not real estate focused CPAs, it just may not be something they're familiar with. That being said, it can be a little bit complicated when you're looking to do and use a strategy like this, and then your CPA is like, no, you can't do this, you can't use this. And I've heard everything from CPAs like this is a scam, or this is it's not legal, or you're going to get audited, and et cetera, because of this. And none of that's true. I mean, this is in fact, according to the IRS, first of all, they created this rule. They govern it. They have what's called the Cost Segregation Audit Techniques Guide, which you can Google. You can go on the IRS website and find it to see how a cost seg is meant to be done, what's considered a quality cost segregation study, et cetera. But they actually consider using cost segregation the correct way to depreciate your property, which may seem like, okay, that's kind of counterintuitive, right? They want you to take more tax deductions. Well, the truth of the matter is, yes, they do, because it's in the tax code and it's benefiting the owners. It's the whole idea of the tax code is really, if you look at it, and Tom Wheelwright in his book Tax Free Wealth, highly recommend that book if you haven't read it. It talks about this idea that the tax code is really just an incentive guide, right? The government is creating different activities to incentivize people to do things, and through that they're given tax deductions. So you can see that's why business owners, et cetera, especially real estate, have so much tax deductions, because it helps contribute to and spur the economy in many different ways, especially commercial real estate. There's so many overlapping factors throughout everything the business does to contribute to the society. So not only are the owners getting that tax deduction, but they're actually reinvesting. They're actually bettering communities. They're doing things to help society in a lot of ways, and so that's why they're giving these tax benefits. So that's, I think, the biggest thing that I get is from CPAs in terms of their hesitation in using this. But again, there's not much else to it. It is pretty simple, pretty straightforward. I know it sounds very complicated, but if you get, like I said, that an estimate on any property, you can see in front of yourself, okay, if I didn't do cost segregation, this would be my normal depreciation deduction year after year. If I do it, this is how much more I'm going to get, and the after-tax benefit, et cetera. Is it going to be worth it? Is it not?
Awesome. Hey, if you're looking to invest in mobile home parks actively and you want to learn how to do exactly what I do, check out getrealcashflow.com. I'm teaching other people how to go out and buy mobile home parks and raise capital for deals and do all the things that we have been doing for over 10 years. Get Real Cash Flow, check it out. And also, if you want to passively invest because you're lazy or retired and you just want to own mobile home parks, put cash into it, go to equitygrowth.net. So, Yona, let me ask you this. We're going to shift gears a little bit. Okay. Let's talk your personal life. You're in Israel. How do you do business in the United States? Because this is a U.S. business, right? Cost seg doesn't exist in other countries, at least that I'm aware of. And so, how are you doing business on a daily basis in Israel, from Israel? And are you seeing challenges, or what's kind of your biggest challenge in doing it?
Yeah, so I mean, our company is based in the States. We have offices across the country. Like I said, we're the biggest national company. So our main office is based in New Jersey. But what I do, everything that I do is essentially remotely. Now, I do travel back and forth. I come in for conferences and speaking engagements, et cetera, throughout the year, probably 5-6 times a year. I'm originally from Los Angeles, so, but I'm, living here for several years and just working remotely. Essentially, the biggest challenge for me, I think, again, I've been doing this for years, so I'm kind of used to it. But the biggest challenge of getting used to was the time difference. So I'm working on U.S. hours, which is a 7-hour difference to Eastern Standard Time, which means, right now it's about 8 p.m. in Israel, although my clock says 1 p.m. Right, so we're that's kind of the difference. So I'm working, from the afternoon and in through the evening. But everything that I do, and the amazing thing is, when COVID started, like I was already doing this. And I was like, yeah, everyone's talking about, going remote and working from home and stuff like that. I'm like, I've been doing this for years. This is easy. Now, I'm sure there are challenges, but I haven't seen many.
You're just used to it. Yeah, I've actually got a few friends that live abroad and do business solely in the United States, and I think they all kind of say the same thing. It sucks to have to work at, midnight, 10 o'clock at night, whatever, but you just kind of get in the flow of it and you get used to it. You're, pretty far, pretty far on the other side of the world, so I can see how that would be tricky, but you just get used to it. And I think that also kind of goes to show that, Americans, if you're here in the United States and, owns real estate in the United States, he, is obviously running businesses and even traveling for conferences. We really have no excuses to being successful when we're in the country, can literally drive to a property or drive to a business and do it. You just need to be a little resilient. So I guess let
Yeah.
me ask you one other thing about the title business. What's your involvement in the title business, and has the title business changed over the last, call it 5, 6 years, 5, 10 years, technology wise? Because I'm starting to see some things in that world change.
Yeah, there are some change, definitely been changes. I mean, one of the things about commercial real estate in general and the title business specifically is that it's pretty archaic in general, and there have been and I'm involved with several startups and what they call prop tech, property technology companies where they're trying to disrupt the real estate world, and it's been going on for 10, 15 years. People trying to disrupt real estate. Unfortunately, it's a pretty, like I said, archaic system. So Madison Title is one of the biggest national commercial title agents out there. We do some residential title in New York, New Jersey, and Pennsylvania, but nationally, mostly commercial title. So we're doing 10, 15,000 title policies a year, and it's very busy. I'd say the past year or two actually has been pretty slow, and I think that's the biggest change because of what's happened with interest rates. Acquisitions have been down, refinances have been down, and so that's where you see the majority of title businesses in those acquisitions, refinances. So that's been a big hit, I would say, to the title business in general. I know we've felt it, but the haven't I personally have not seen too many changes. I know there are
Yeah.
things people talking about using blockchain and things like that for title. I think there's a lot of potential for it, but because the industry in general is so old school, I think it's
Yeah,
going
it
to be
is.
difficult to for these companies to adapt to that kind of
So
stuff.
so I just sold and I agree with what you're saying. It's definitely we've been doing something for a very long time and it's hard to get out of that groove. And you're dealing with government, very archaic government systems and, things like that haven't changed. But I just had a closing last week. I sold an asset that I've owned for, I don't know, 10, 12 years, something like that. And I never once spoke to a person at the title company. The broker who sold it for me basically sent the contract off. I got an email. It had a few things that I had to fill out in a format, not even paperwork.
Right?
Completed that. Everything was done through a portal
Mm,
and basically closed. All documents were signed online
digitally,
and
yeah,
yep, digitally. And I got a wire into my account. And I went, I haven't done a closing where I just never once spoke to a title company, or I don't even want to say there was maybe one or two messages in the platform between us. Other than that, it was very hands off, which is
that's
nice
pretty
as
cool.
a seller. So I think we'll see more and more of that. Some of the automations and some of the, technology platforms taking a lot of the communication out of it and automating things. But I
Hmm.
agree with you. A lot of it has stayed similar. So what I wanted to do is make sure I got you on, talked about cost seg, talked about some of these tax strategies, and it's been very helpful, and I hope a lot of people got a ton of good nuggets out of this.
Yeah.
Who should contact you, and how can they get a hold of you?
Yeah, absolutely. Really anyone. Feel free to reach out to me. whether you're a real estate investor, whether you're looking to be involved in it, I offer a free consultation. You can find it on my website, yonahweiss.com, or you can find me. I'm pretty active on pretty much all the social media platforms. LinkedIn mostly is my biggest one, but you can find me on Twitter, Instagram, Facebook, and I'm pretty responsive in terms of messages there. Feel free to reach out. Even if you don't have a property, again, you're just kind of looking into real estate or have questions. I love to network, love to meet new people. And do me a favor, don't just hit that follow button or that connect button. Take 10 seconds and write a little note that you saw me on Mario's show, and that would make all the difference in the world.
That would be awesome. Yeah, guys, he's all over the place. He's easy to find, and he's got some really great nuggets. So make sure to connect with him. Yona, thanks for being on, man. I really appreciate it, and looking to doing some business with you. Take care. Thanks for listening. I hope you got out of this as much as I did. I'd really appreciate it if you could leave a 5-star review so we can reach more people. Jump over to mariodattilo.net and find out what else I got going on. Be sure to connect with me on all the socials, and I'll see you on next week's show.